Welcome to another episode of Millennial Investing Explained. Here's today's question. Now I want to turn the page and talk about another choice you have when investing with your brokerage account, and that is investing in bonds or bond funds. Now, a bond is different from a stock because when you buy a bond, you don't have any ownership in the company, whereas with the stock, you get a small ownership of that company, like I said before. When you buy a bond, you're actually just providing debt to that company. Just like a bank would give a loan to you or provide debt to you to buy, say, a car or a house. When you buy a bond, you're giving cash, you're giving money to that company so that they can invest in their business ideally. They could invest in R&D, they could build a new facility, they can invest in starting new products. They can do whatever they want with the cash, but really what you're doing is you're providing cash to the company in the form of debt. And then over a period of time, the company pays you back with interest, and that interest is then your return. In general, the interest is paid quarterly, but it doesn't have to be. It can be at any interval that the company defines. It could be semi-annually, it could be annually, it could be anything that the company defines when they're issuing their bonds. Bonds are set up so that at the end of your investment period, you get all of your initial investment back. But of course, that is only as long as everything goes as planned and that the company is doing well. If the company ends up not doing well and they aren't generating enough cash to pay back their debts, then there is no guarantee that they could pay you back. And you can think about that from a consumer standpoint or from your own standpoint. If a bank gives you a loan for a car and you lose your job and you can't pay for that loan, you can't pay for your debt. And it's the same for a company. If they get debt from you and then they run into issues and they aren't generating as much revenue or they're not making as much profit, they may not have the cash to pay back their debt holders, which would be you, the investor. And then in that case, you may not get your interest or your principal back at the end of the period. Now, that being said, there are some bonds that are considered risk-free, and those bonds generally come from the US government, and they're considered risk-free because they are backed by the government. Essentially, the US government isn't going to default on their debt. They could just print more money to pay back the bonds if they needed to. You know, it's not quite that simple, but in general, US government isn't going to default on their debt, so those are considered risk-free bonds.
It's very interesting you talk about risk whenever it comes to bonds. And I think it's important to emphasize that if you compare that to the dividend, a dividend of a stock, meaning that you get a share of the profit of that company, it's different. You have to pay the bondholder before you are potentially paying anything to the shareholders of that company. So you can actually declare the company bankrupt. You can actually take them to court if they don't meet their debt obligations. You can't do that with a stock because you have a different upside, but you also have a different downside. And then you talk about the government. It is slightly different. If you're a Starbucks, I don't know why I keep talking about Starbucks, but if you're a Starbucks, you can't print your own money, right? Like if you have no money, you have no money. You might try to raise capital one way or the other, but if you need money and you don't have it, well, it's just like for you and me. We don't have money. The government can continue printing money, so that's why Robert's referring that to risk-free. So I also here would like to emphasize that risk is always one side of it. The reward should also be included. So that's why these so-called risk-free investments, call them 2% or 2.5% that you can get from the government. That's why that is so low, and why if you're going to a corporation, even a well-known corporation like Starbucks or McDonald's, Coca-Cola, why they are forced to pay you significantly more in interest, simply because there's a risk attached to that, because they can't print their own money.
Then you have an individual organization that's well known, like, say, Tesla, who's considered to be even more high risk than other individual organizations, and that causes investors to require an even higher rate of return. So really, it is that dynamic of higher risk requires a higher rate of return. Now, an important distinction I want to make here is that when investors buy bonds in their brokerage account, they are actually buying a bond fund. They're not actually buying a bond itself. And I would say today that it's far more common for an investor to buy a bond fund than it is an actual bond itself. When you buy an individual bond, it's sort of like owning an individual stock. It's different in the sense of debt versus ownership in the company, like I said just a few minutes ago. But how it's similar is that you're relying on that one entity, whether it be a corporation or a municipality. You're relying on that one organization, that one entity to pay you back, and you have a direct relationship with that entity. Just like if you invested in an individual stock, you're then relying on that one company. But when you buy a bond fund, like a bond ETF, say, the ETF owns the actual underlying bonds. And then as the investor of owning the ETF, you then own a percentage of those underlying bonds. Just like the stock ETFs, now you have a diversified portfolio of bonds within your ETF. And that's usually a low-cost way to greatly diversify a holding of bonds. I personally haven't owned an actual bond itself. I have briefly owned a bond fund before, a bond ETF, but I've never actually owned a bond itself. How about you, Stig? Have you ever owned an actual bond?
Yeah, good question. No, I actually never owned an actual bond for the reasons that you also mentioned. And as you suggest, when you start up, a bond ETF is typically the best choice. It's definitely a lot easier than to go into a specific company and try to read their financial statements and figure out like the debt situation. Yeah, I'm a buy and hold investor, and like everyone else, I haven't been able to make a decent return in government bonds for a long time, given the low interest environment we're in. And with the interest rate being low, I'd say that typically stocks are a better investment. But we have had periods of time, even decades, where the return on bonds exceeded that of stocks. Another thing to keep in mind is that generally bonds are not popular with millennials, at least not at the moment. I need to emphasize that. The reason is that fixed payments, which is what you get from bonds, and often lower expected returns are more appealing as you approach retirement, and you need to replace your income with a steady stream of cash flows, rather than accumulate your wealth, which you very often would do in stocks.
Yeah, I think part of the lack of interest with millennials is the fact that they're not quote unquote cool. You know, it's rare that anyone is going to brag about owning a bond or a bond fund, whereas you could talk to your friends and kind of brag about owning a high-flying tech company like Uber or Snapchat. You know, you're not going to go to a cookout or your family's house or, you know, a holiday event and say, hey, I own US government bonds and be excited about that. Whereas if you're investing in a company like, say, Uber or Snapchat or Apple or Facebook or anything like that, you can go to those parties or those events and you can brag or talk about that to the other people that are there, and you can be excited about it. And that can add a cool factor because you now own those companies. And I think that plays a big role specifically for millennials. Another interesting point about buying a bond fund or a bond ETF versus actually buying a bond itself is the liquidity factor. And I think this is important because when you have a physical bond, when you have an actual bond itself, in general, it's hard to get rid of that early. You know, if you have a 10-year period, it's difficult to get rid of that bond early. You can, but when you cash it in, you're going to pay a penalty or you're not going to get all of the interest. And so it's difficult to get rid of that actual bond. Whereas if you have a bond fund or a bond ETF with your brokerage account, you can just buy and sell that with your account just like you would a stock. So it's much more liquid. It's much easier to buy and sell the bond fund than it is an actual bond itself. So that's just something to keep in mind when you're considering potentially investing in bonds or bond funds. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.